All right, everyone. I appreciate you waiting a couple minutes there while I was just getting everything set up. Want to welcome everyone back to the morning stream. I hope everyone's having a good day. For those of you that are new to the channel, my name is Sean Ryan. I'm co-founder of Predicting Alpha, and I run this live stream every day to help you shape the way you're viewing the markets, to go from, uncertain market speculation to well-equipped, confident trading. That's really the whole point of this stream, right? To give you some ideas that aren't just based on some chart artist's opinion on, how pretty the chart looks, but really based in some evidence, right? Some evidence about, what the market is telling us, what we've seen historically, really taking a quantitative approach to trading easy. So if you find the value in this stream, to be beneficial, make sure to drop a like, drop a subscribe. That's really all I ask for in return. And the real star of the show is this Predicting Alpha terminal here, which helps me break down markets easily and efficiently. It allows me to look beyond the charts, see what's really going on, and easily identify areas where I disagree with the market. And as we all know, that's really what makes a good trade is where do you disagree with the market, and can you structure a trade to express that disagreement? So today, we are going to focus on earnings trading. We have a couple of different earnings, Disney, Ddog, DLR. We're going to take a look at each of them, structure out a trade if I see an opportunity there. If I'm on the fence about something, I'll explain why. Remember, the whole point of the show is a couple of different things. We go from idea to research to trade structure, right? We follow those 3 steps over and over. You want to find an inefficiency, you want to understand it, research it, try to explain why it's there, and then you want to structure a trade to express a view on it. And if you follow those 3 steps, you will always have confidence in your trades. Whether they are winners or losers, you'll be able to stand behind the decisions you make. You'll be able to understand why you took those trades. And in the end of the day, that's the level of confidence we need to come out winners in this game in the long run. So let's hop right into it here. Let's start with an analysis on our first stock of the day, which is Disney. Now, Disney is probably the one that everyone has their eye on today. I'm going to quickly pop over to StockTwits here. And let's take a look at what the word is on Disney. Disney's been a very popular stock for the last little while in general, right? Look at this. 200,000 people in the retail space, just through StockTwits alone, watching Disney. We can see that the message volume today is already up 15%. Now, it's not quite as big as it was around the last earnings, but we could expect to see the number of watchers today really ramp up. This is an event that everyone seems to have their eye on. If we look at the retail sentiment here, of these 200,000 people watching it, 95% of them are bullish on the stock, meaning they think this stock is going to rally on this earnings, right? If we read through here, we see that all these comments are all bullish. Everyone's betting on this thing going up, right? Here's one guy with like an incoherent comment why he's bearish. Disney's going to fall to 185 today. Cool. We're trying to move away from this, right? Like, what does this mean? Come on, Disney won. Like, someone just like this can't be research, right? We can do better than these guys, right? We can have the edge over them. And the way we're going to do that is by taking a deeper look at this earnings and breaking down what the data actually has to say. So, when we look at earnings, we want to see a couple of different things. Number one, I want to see. What we have to do, first of all, is isolate the earnings event, right? So that's why I use this terminal. That's why this earnings analyzer tab is so valuable to me. For anyone who takes earnings seriously, guys, there's really nothing better out there than this. I don't even think a Bloomberg has better option data for earnings than this. So first thing we want to do is look at what the earnings implied move is. What's the market saying this thing is going to move around earnings? And we can see that it's saying we can expect Disney to move up or down 5.29%. Now, that's not just what the market thinks is going to happen. That is actually what is being priced into the options right now. Meaning, if you go and you buy a weekly option on Disney right now, you are paying for a 5.5% earnings move. Well, the question we need to ask ourselves as diligent traders is that a reasonable expectation for their earnings move. Because if we think that that is an unreasonable expectation, well, then we could maybe draw the conclusion that the options are mispriced, right? Because this is going to take up a lot of the juice of these options, especially the ones expiring tomorrow. So, implied move of 5.29. Well, maybe the first place we can start is, what is the average move, right? What is this thing on average? Disney isn't a new company. This isn't their first earnings event. What's it done historically? And we can see that its historical average move is 2.61%. That's including all the blowouts, all the little moves. If we average it out, we see that Disney actually moves about 2.61% around earnings, right? And that's not to say it's never moved more, but that is to say that on average, we see it a lot less. And maybe the next step we could take is, well, we know what it does on average, but what does the market say it does on average? Because let's say the market is usually correct, right? Keen, what's going on, man? Let's say the average implied move is 2.61, and we see the average move is 2.61, and we see that the average implied move is also 2.61. Well, if it's implying 5.29 this time, we have an idea that the market is pretty accurate. Right? They're not usually overstating or understating vol. But what we see here is that the average implied move, 2.61 is the move, Sylvain. We see here that the average implied move is 4.24, meaning on average, the market is overstating volatility by about 2 points here, right? 2%, or you could look at it as 2% move, or they're overstating it by they're saying it's twice as big a move as it usually is. Right? Now, remember, guys, full disclosure, that's not to say that there couldn't be a blowout here, right? In fact, which I'm leaning towards off the bat, if we were to sell vol here, we are embracing that risk, right? Why is someone paying us so much? It's for taking on the risk that this thing does have that big move. What we're trying to do, though, is find where people are willing to overpay us for that, right? Where the retail guy is willing to pay that extra few dollars for that call that makes that difference, or where the hedge fund's willing to pay that extra premium to hedge their book because they hold a ton of Disney, right? That's really all we're trying to do here, but we're not trying to just guess. We're trying to put some evidence behind our ideas, because evidence-driven decision-making beats market speculation every time, especially in the long run. So, off the bat here, things are looking like it's probably a good short vol play. In fact, it's looking like a great short vol play. Another question I want to ask myself, though, is, okay, well, if I had sold vol historically, how would I have done? Would it have worked out for me? And what I can do for that is I can look at this strategy P&L, which shows me 3 different things. It shows me straddles, calls, and puts. And the question it asks is, if I had bought a straddle, or bought an at-the-money call, or bought an at-the-money put, going into each of the earnings events for Disney, bought it at the close, sold it at the open, how would I have performed? And here's what we see. We see that buying volatility going into earnings has been awful. It has not worked out. In fact, you would have lost 200% of the initial risk you put up, right? So if you bet, 10 grand every time, you'd be down $20,000 right now. And what we can also see is that calls were down. You'd be down overall on calls, and you'd be down on puts. So being on the buy side here historically has been systematically unprofitable. Now, that's not to say the market doesn't get smarter. That's not to say it doesn't change. But we're just trying to paint a picture here that we can compare to what the market's showing us to say, hey, guys, maybe this is the way we should be structuring a trade here. So if we got any of our theta gangers in the chat here, I'm sure you guys are loving this, because short vol here is looking pretty damn juicy. Another thing we can take a look at is, okay, earnings is released 4 times a year. Well, is there a particular season or quarter where we see these big moves, right? If we come back up here, we take a look at the moves for each event. We see here it moved 8% back in August of 2020. It had a huge move. Well, looking at this seasonal impact graph, I can see that Q1, Q2, Q3 have never seen moves bigger than what it's implying right now. It's only ever been in Q3. Sorry, if I said Q3 before, I meant Q4. So I'm starting to build a picture here that this is really expensive. We've never seen a move this big at this time of the year. We've only seen it once in the last 3 years of earnings. Selling vol has been extremely profitable here. The market seems to always be overstating it. Well, I'm starting to think that this is a damn good short vol play, and I would be taking it. So what I would do is let's structure out what that trade might look like. Let's come here and type in DIZ. All right. So now here's the thing to think about, everyone. For Disney, we are trying to isolate the earnings event, which means we want to be trading a near dated option. We want exposure to that realized move, right? The nearer dated we trade, the more sensitive we are to an actual move in the stock. The further dated we trade, the more sensitive we are to a change in the implied volatility or the future forecast. So I'm going to be looking at trading this, either this February 12th contract or this Feb 19th contract. And it really will just depend on the liquidity. And taking a look here at the money, it's pretty liquid. It should be okay. Now, if you're uncomfortable with that liquidity, you can go out to these Feb 19s. These are pretty, pretty good exposure to the event as well. But for the purposes of this live, I'm just going to stick with the Feb 12s. So we know what we want to do. We want to be shorting vol going into this event. The best way to do it is to just come in here and sell a at the money straddle. So I'm actually thinking the best way to do this here right now would be to do the strangle. All right, 190, 187 strangle. Keep it delta neutral as possible. This would actually be the ideal way to do it. Right? We're delta neutral at inception. Our break evens are at 178 and 198, which is that implied move, right? So the reason the straddle is the best way to do it, right? So this is a question I get all the time about straddle versus Iron Condor. Is that straddle is basically this implied move, right? Like, let me just do something here quick. Our break evens are at 178 and 198. The stock's trading at 188 right now. So if you just do a 5 point, if you take the current stock price, because it's so near dated, we can actually do this, multiply it by 5.29%, you actually get your break evens. So what we are actually selling here is that 5.29% move. And if the stock moves less, it's going to stay in our body here. And if it moves more, we're going to see it move out of it. Right? Remember, the market tries to give a fair bet, meaning a expected value of 0. But by selling this straddle, we're basically saying if it is 0, we're going to break even. But if it's less than the implied move, we're going to make money. If it's more than the implied move, we're going to lose money. And that's the trade, right? That's the actual trade itself. So take note of this, right? Our current break evens are 178 and 198, right? I'm going to type that in the chat quick just so I have it there. But now let's see what happens when we buy the wings. Okay. So this is going for $9. So what I'm going to do is I'm going to come here. I'm going to sell an Iron Condor and I'm going to go 2 standard deviations. So we're going to sell the 190, 187. All right, let's do 190, 190. Just for simplicity here. Or actually, okay, we're going to go $18 either way. So 190 plus 18 would be 208. Do we have a strike for that? No, we don't. So let's go 20. Okay. 20 up, and then we're going to go 20 down. So that's 167.5. So this would be our Iron Condor. You can see we're paying about $1 for the wings. But what that has done for us is we go from having this unlimited risk exposure, right? Which, things do happen, right? Stocks do have 3, 4, 5 standard deviation moves. It happens. So to protect ourselves from that, we pay $1, we get these wings. Now our max loss is capped at 12 grand for a 10 lot here. A little bit less than a 1-to-1 risk reward, but don't forget, it's not all about risk reward. It's about probabilities of being right as well. So what else has changed by buying this Iron Condor over this Straddle or Strangle is our break evens have gone from 178 and 199 to 179.5 and 197.8. So look at what happened here. By buying the wings, our break evens have come in a little bit. Right? Let's think this one through, right? Let me share my whiteboard here. Hopefully this doesn't make my computer explode. It's been a little laggy recently. Come on, whiteboard. Okay, maybe not. Maybe no whiteboard today, guys. We'll let it load. We'll see if it decides to cooperate. But think about what's happening there. We want to be selling that 5.5% move, but by buying the wings, we're actually selling, let's say, a 4.5% move. Now, buying the wings here isn't going to crush your edge because, as we can see, we're expecting it to move somewhere closer to the 3% range, but you are giving up a little bit of your edge for protection. So what can we do here? Well, one thing that we can do, and this really depends on your risk tolerance, the size of your account, all of these things. Because look, this is not a cheap spread to put on, right? We're looking at, for a one lot, it's $800. Funny guy, Eric. Yeah. Right, check this out. Right, you can have a max risk of $1,200 on the Iron Condor with a payoff of about $800, or for this Straddle you could put it on oh wait, wrong button. Payoff of about $900, and if we were to stress it to like a 3 standard deviation move, it'd be somewhere over here. Max loss of about $2,500, but that's unlikely. Right? It's unlikely you'll realize this max loss or this max gain. It'll be somewhere in between. So what we can do here is, the ideal way to play it is probably to sell the Straddle or sell the Strangle and size it accordingly so that if you get a massive move, it is bearable for you, right? So if you can take, a $2,500 loss, the ideal way to do it is not to put on 2 Iron Condors, right? Look, you'd have your $2,500 loss. It would probably be to sell this Strangle. Now, obviously, if you do the Iron Condor with 2 lots, you see, it's like, well, my max payoff is higher here. But your probabilities of being right go down. So that's the trade-off, right? And I think that with these trades, the edge is so small that we need to really focus on maintaining that probability of success, right? More so than the risk reward, which is, I think, something people get a little bit backwards when looking at earnings. So this was my... for this live, this is the one that I'm going to go in depth on, right? I think I've got one more bit to talk about here for Disney. Besides that, this is the in-depth one, and we're going to fly through the others, seeing as we're already at 10:50. So to build onto it, Armando, what's going on, man? How's life? Armando, did you rewrite the bronze test yet, man? I feel like I haven't heard from you since our last convo. So the only question left for Disney, right? I think this looks like a pretty good trade, whether you do the Iron Condor or you do the Strangle. You're looking pretty damn good either way you spin it. The next question to ask is, okay, when do I put this trade on? When do I take this trade off? So we are going to put this trade on at the close today. The reason, if you want to take it, of course, right? Remember, this is not financial advice, whatever the disclaimer is. Don't listen to me. Do the opposite of me, actually. But, if you want to take this trade, you want to be putting this on at the close on You're saying check the chat? Yeah, give me 1 second. Eric, what are you saying here? Butterfly. What's this for, man? We'll take a look at that together after this, Eric. You're going to put this on at the close, because if we come back to the earnings tab here, all we are trying to do is express a view on earnings. The better you can express your view, the more you get paid for being right and the more control you have over your trade. If you don't want exposure to non-event vol, why would you put this trade on right now? You have an entire day before earnings. So it only makes sense to put this trade on at the close, right? Try and get filled at like 355. Now, the market closes, earnings comes out, whatever happens, happens. It's the morning time now. What do I do to manage this position? Well, what you need to ask yourself is, when is the market, we took a view on the earnings. So what we want to do is we want to exit when the market is no longer pricing in an earnings event. Now, one way you can do that is you can, kind of a quick and dirty way, you can come out here, take a look at, the further dated vol, see what it's trading for, 41 here, and 56 here, or 92, sorry, and 41, so like 50 points there. But what I like to do is I just come here, I look at the term structure graph here in the PA terminal. Right, this is something super unique to the PA terminal. Nowhere else offers this. Implied move with the event vol stripped out, 35. So you can see that we're actually expecting about a 20-point drop in implied volatility. This is like the cleanest way to do it. Can't actually get this anywhere else. So what we can do is we can come here and say, like, well, what will our position look like tomorrow? Let me see. We will come in here and we're going to drop vols by 20 points. And we are going to move forward one day. This is what our P&L will look like first thing in the morning. It'll fall somewhere along this line with the purple here. So the questions we need when we're going to exit is when we see this 20-point drop in vol, because that means the market is no longer pricing in the earnings. So we're going to follow that guideline if we are still within our body. But if we have a blowout, right? Let's say the stock moves, look in the middle here, all right? When we're here, we have a Vega sensitivity of 7. When we move out here, it's now 0.4, 0.5, right? Even here, at $204. So if we were to get a big blowout move, we actually have no sensitivity to Vega anymore. So get out. It was a loser. It happens, right? Part of trading is we got to embrace losses, and that is when I would exit. 2 situations I exit. Number 1, it stays within my body. Implied vol drops to non-event vol. Situation 2, the stock moves too much. My Vega sensitivity is gone. I was wrong. I get out. That is the 2 scenarios in which I will be exiting this Disney position. Now, let's keep it rolling here. Guys, if you found that useful, please make sure to drop a like on the video. The YouTube algo gods are still not loving PA. I think they know that this is the sauce that will change the game for retail. And they want to, the big money does not want this information getting out there. So let's quickly go over the other 3 earnings for today. We're going to start with DDOG. So DDOG earnings implying a move of 8.5%, average move 12%, average implied 11.45. The thing to note here, we do not have a lot of data points. Okay, we've only seen a few events. Everything's pretty flat. The one thing that I do like about this is the implied move is pretty high. Right, it's implying a move of 8.5%. Even though it's lower than the average, we can't really rely on this. We only have 4 events to look at. I think shorting vol here probably not a bad idea. I would definitely scale down on this one. One thing I like about it is it does meet my criteria for having that high level of implied move. And, you know, one of the things about this earning strategy, if you're going to run it really optimal, is anytime that they meet your criteria, put it on, because, you know, your edge is so small on any given one, you could be right or wrong. You just need that small edge and enough events to play across to come out a winner. So let's data dog really quick. Next up, we have ILMN. Okay, not seeing a huge edge here. Looks like the market is pricing things pretty fairly. Long vol here has been, you know, pretty flat. We can see that it usually, okay, so every single earnings for the last like 2 years, it's actually moved down on earnings. So if you wanted to take a bet on this thing going to the downside, might not be a terrible idea. You know, we can see a little bit of skew to the downside being priced in. The market's basically saying if this thing's going to have a big move, it's going to be to the downside. So let's go take a look at this chain quick. ILMN, was that the ticker? I can't remember, guys. Let's come here. Let's take a look. ILMN. Okay, a little bit of that skew here. Maybe we can take advantage of it. Let's have a look. Let me sharpen my eyes a bit here. Oh, wow. Take a look at, that's the ask. $1. Here, okay, check this out. Wait, this can't be right. Give me a second. Why is it pricing this for a credit? Bid, ask. What is going on here? Give me 1 second, guys. Hold up, hold up. Let's see if we did. Yeah, okay, these prices are a little messed up. Eric, get on this, man. This is your type of trade right here. Wonky prices in the chain. Right, you can see it gets so much cheaper if we just go down a buck here. Okay, so we would do something like this, like a vertical spread. Oh, man. The one that I actually want to do, the prices are all screwy right now. Like, look at this. Put on a vertical for a 55-cent credit. It's an ARB. Hey, if you can get someone to give you this ARB, you know, nothing wrong with it, right? At the worst, you make $500. At the best, you make $3,000. What a tragedy of a position to put on, eh? But yeah, these are actually the strikes that I'd be looking to do. Something around the 454.47 put vertical. We're taking advantage of that put skew that we're seeing here. This is something that I would definitely be doing if you're bearish on this stock. You have the data to support you because, you know, vol's fairly priced, but there's put skew. So the out of the money put that you're selling a little bit pricier than the at the money put. And for the last 1, 2, 3, 4, 5, 6, 7, 8, 9 earnings events, it has been a down move. Maybe it's worth taking the bet that it reaches double-digit down moves. All right, let's keep it rolling here. We got one more to take a look at. DLR earnings. DLR, let's see what's going on here. Implied move 2.8, average move 3, average implied move 3.43. Market's saying this stock is not going to move at all. The current implied move is the lower end of the actual moves we see in this quarter. Now, this stock does, you know, tend to stay pretty stagnant a lot of the time, but it has had a couple of big blowouts, right? You know, in recent times, 2 out of the last 6 earnings would have been good long vol plays. We can see here that buying vol pretty flat. And when you can get a break-even long vol play like this, it's probably worth taking a little gamble. You know, I would say go for it, right? For all of you long vol junkies out there, this is probably not a bad way to be going about it, right? Come in here. What was this ticker again? DLR. We're not going to get fancy with it, guys. Well, we only have the monthlies here. That kind of sucks. So maybe not. You can't really get as much exposure to the event as you would like. But let's price it out and see what it would look like. So let's say we bought a straddle. Cost us $5. So this is the position. Let's see what it would look like after earnings. First thing we got to do is see what the vol is going to drop to. We can see that vols will drop from 29 to about 23. So we're going to see about a 6-point drop in vols. Come here. We do the vol adjuster minus 6. Okay. So our position is going to fall somewhere along this line here. Right? Tomorrow after the event, if the stock does not move, let's go to a one lot, make it accessible for everyone. You're risking about $161 maximum risk if the stock moved 0, which, not super likely. Let's say the market's about right, a little bit on the wrong side, you'd lose about $75. But if you were to get one of the bigger moves, let's see what it moves if it does beat the expectation. Moves about 4%, 5% on average on the high side. So that would be about a $10 move. Stock goes down to 140. You would make $450, right? So, you get a lot of that convexity here where if we do get a big move, it's going to print. You're risking about, now it's saying you're risking 150. Did the prices change or something? What's going on? Were my eyes deceiving me? I don't know. The overall volume is pretty low on ILMN, hey? Okay. Good catch there, Tim. I haven't been looking at that. So, yeah. This is not a bad long vol opportunity, right? DLR. Shout out to DLR. So, with that being said, guys, that's going to wrap up this morning's live stream. If you found this valuable, all I ask is you drop a like on the video. And if you have a friend that is really into trading, takes it really seriously, please share this live with them. I'm here every day. I've started posting more videos to the channel. Just posted a video today. Sort of trying to turn this into a series where I go, it's my idea, research, trade. Right? Every video follows that same 3 things. I'm going to share how my thought process works for relevant trades, things that are happening right now. Today I just posted one about the cannabis sector that I recorded, a couple days ago, or yesterday. And I love your feedback on that video as well. So if you want, after this, go take a look at that video. I'd love to know how I could make it better. Remember, my only goal here is to help you move from uncertain market speculation to well-equipped, confident trading. If I can do that, life's good. Eric saying signals everywhere. In the end of the day, man, Eric, if you had to pick, man, all the work or a signal, come on, you're gonna take the signal. You just there's no money in the signal, man. It's all about finding your own edge in the market. So, with that being said, everyone, thanks so much for tuning in. If you're new here, hit the subscribe button. You already know. And we'll see you tomorrow. Friday live. Usually try to keep it fun on it. We'll see you then.